how to optimize your portfolio in retirement. That's what we're going to talk about here today. I think this is part 5. So if you haven't followed the series up to this point, I highly suggest you go back because we start showing the academics behind this and the use of annuities. We're going to talk about that a little bit in terms of practicality, how your remaining portfolio should be allocated once you use an income annuity, not talking variable annuities. And if you hear the word annuities and run for the hills, I just think you're mistaken grossly, actually, as a matter of fact. I think you're letting a closed-mindedness of the evils of annuities affect your ability to see retirement planning the way it should be. But I can't control what you do. I'm just saying, this is the way to optimize your portfolio, bar none. And basically, it's not that much debate, frankly, anymore about the value of an income annuity in retirement. All right, so the question is, what happens after you allocate a certain percentage of your money to an income annuity? What do you do with the remaining of your portfolio? And that's what we're going to talk about here today. So welcome to Heritage Wealth Planning YouTube channel, my friends, the place you come to learn how to maximize your portfolio in retirement. All kinds of retirement planning, tax techniques, the whole thing. If you like it, subscribe, thumbs up, and comments always welcome. So before we get into it, just want to take a moment and recognize Charles Abbott Associates, CAA Professional Services here in Milton, Georgia. Maybe they're in Alpharetta. I can't tell. So I just got back, my wife and I, from a breakfast here in the town of Milton, Georgia for veterans, because tomorrow's Veterans Day. And they honored veterans here in the town. And Charles Abbott and Associates gave us all a gift card, which is pretty cool. I also want to recognize Laurel and May Market and Basket, or Market and Bake Shop. So if you're in Milton / Alpharetta and you're looking for building inspection and plan check, environmental compliance, city engineering, and fire prevention, I would say look at Charles Abbott Associates. If you're looking for a bakery and market, and they do mugs here in Alpharetta and Milton, look at Laurel and May. And then Old Blind Dog, they sponsored a lot of the food that we had there this morning as well. So just those are 3 firms. Old Blind Dog's a restaurant. My wife loves their French onion soup, by the way. And if you're a drinking man, you can get lots of Guinness there and Bass Ale. I think they had Harpoon. I can't. What's the? So you got Bass, Guinness, and there's another one, Newcastle. I can't remember. But anyway, I don't drink, so it's been a long time. So I just want to recognize these groups for sponsoring the Veterans Day. I say celebration, not even memorial, just appreciation, if you will, for the breakfast that we had here in Milton, Georgia. And just while I'm on the line of it, I just for you who have served, man, I tell you, I got nothing but respect. Nothing but respect. I don't care what you did. I don't care if you worked in the mortar pool, if you worked as a cook. I don't care. I never went to combat. I'm just, whatever you did, if you did it, I just appreciate what you've done, because I got 4 kids, man. And they would be worse off if you didn't do what you did. So always remember that. And there's no way you can say how much appreciated your service is, regardless of your MOS, military occupation specialty, regardless of what unit you're in, regardless of what branch you're in. And that's include Coast Guard people too. I think we forget a lot that Coast Guard are veterans. They are service personnel. So you Coast Guard personnel too. In fact, that's almost like they're forever in combat when you think about the duties they're doing relative to what I did, just training. All right, so let's dive right into this. I got what I need. Yeah, okay. So what we're going to talk about here today, let me get my PVC pipe. And I'm putting together a bunch of PVC pipe. Just got back from Lowe's, and I had to buy a bunch of 5-foot, 3/4-inch PVCs with a bunch of connectors and a bunch of tees, because I'm doing something for my daughter going down to Georgia Tech tonight to watch the football game. And they were going to build a little PVC pipe thing to put a curtain as a background so they can take pictures of her and her little crew down there. So PVC is awesome. All right. So here we got a portfolio of $500,000. All right, and you're 50-50. You're 50% stock, 50% bond kind of guy. Well, what does that mean? We got $250,000 in bonds and $250,000 in stocks, because you're 50-50. Nothing rocket science there, right? So now you say, Josh, I want to maximize my portfolio in retirement. So, but that also means I also want to start drawing income from this guy. So what I can do is I can say, I can draw 4% a year. And 4%, well, just using this for example, I'm not saying this is what you should do, just to give you the basic guideline of cliched boilerplate financial planning. 4% on $500,000 is $20,000 a year. And we're going to adjust that each and every year for inflation, whatever inflation is. That's the epitome of the 4% rule. However, the 4% rule is really contingent on a 60-40 portfolio. It's not contingent on 50-50, and certainly not contingent on 40-60 or something worse, or something lower from your stock to bond exposure. But we're just going to go with this for the time being. So we're going to say, look, I got 500,000 bucks. I'm a 50-50 investor. I put 250,000 in each of my stocks and bonds. I'm going to take 4% a year on. That'll be 20,000 a year adjusted for inflation. And I come up there and say, yeah, let's not do that. Let's take $100,000. We're going to move it to an income annuity. All right, and we call that a single premium income annuity, a SPIA. That's one of the words you can call it, but it's an income annuity. And so that $400,000, if you're married, probably pay you $4,500 a year in income. $4,500 a year in income. All right, so $4,500. If we divide that by, there's my trusty calculator, which would be how much a month? Because we're saying 65 married filing jointly, 4,500 divided by 12 is $375 a month. All right. Now, a couple things on that with just that annuity that you got to understand is that the annuity is based on how many lives are insured. All right, so in this case, I'm taking a 65-year-old couple, and I haven't run any quotes, but just generally speaking, if memory serves, that's pretty close to 4.5%. So we got Charlotte and Josh, we're both 65, and we're both going to have this insured for the rest of our lives. So just a joint life annuity. I get hit by a bus tomorrow, my wife still gets that money, $4,500 a year until she dies. So she could live 30 years, she could live 20 years, it doesn't matter. She will still get paid. At the end of my surviving spouse's life, my wife, Charlotte, dies, there's no money yet to be paid. It's gone, all right? That's how a joint annuity works. Now, if I just did it on my life, it'd be $5,000, all right? So basically it's 5% on one life. So it's basically 5 on one or 4,500 on two. It's kind of the rule of thumb there, and that's what you're looking at. And really what you're looking at is not 5,000 to 4,500. It's really 5% for your life or 4.5% for joint life. Now there will be differences, just be advised, but just for a rule of thumb, that's how an annuity works. If it only pays on one life, well, that means the insurance company is taking on less risk because at the end of my death, it stops. If it pays on two lives, that means the insurance company is taking on more risk because they anticipate paying out longer, thus they pay you less. And so just in the back of your mind, roughly 5% on a joint life, 4.5% on a single life. If you're 75, it'd probably be, instead of 65, maybe 5.5% to 5%, something like that, and you can run those numbers for yourself. All right, so we did that. So let's just erase all this. So now we got $100,000 in that annuity, in the SPIA, which is paying us what, $4,500 a year. But no, we no longer have $100,000 here, so we got to reduce that to $400,000. All right. Now the problem with this is simple: is that this annuity is no longer on the balance sheet. So the balance sheet is this $400,000. So if I say how much you have in your account, you'll say, well, I have $400,000. And I'm like, well, that's $400,000. That's not a true assessment of your total account value because you are having a liquid account. I mean, not a liquid, but you are having an asset right there that's paying you an income stream. But it doesn't go on the balance sheet, but it does go on the income statement. I know it's tough to think about. The income statement is cash flow, money going in, money going out, money going in, money going out. The balance sheet is your assets minus your liabilities. That's your asset. That's your balance sheet. But not to have these things coordinated for some ungodly reason is silly. I mean, why would you not coordinate your asset, your balance sheet with your income statement? Because they both flow to optimize your retirement plan. And so again, someone says, oh, you only got $400,000 in your IRA and you're a 50-50 investor. You should be $200,000 here and $200,000 there. But the problem with that is you're not, because what that means is now you have $200,000 in bonds plus your $100,000 in your annuity. So you're literally now $300,000 and $200,000 because an annuity is a bond. All an annuity is an income bond. That's all it is. Now, there is a difference between a bond and an annuity. A bond matures and you get your money back so long as the company that issued it doesn't go bankrupt. But at the end of the day, you own a bond for income. That's what you own a bond for. There's no other way around that. So if you have an annuity, instead of receiving the maturity, the principal at maturity, you'll get all that money over the course of your life, however long that is. An annuity is a bond. It's guaranteed, never to go away, 100%. In fact, the annuity, how they invest it, they're investing in bonds. So it's a bond. So now to say I got 100,000 in my annuity and I'm still a 50-50 investor, well, now I'm not a 50-50 investor. Now I'm 60, or I should say 40-60. I got 40% in stocks and 60% in bonds because I got this 200,000 plus that right there is 100,000. Now I got 300,000 in bonds and 200,000 in stocks. And that makes me 40% stocks and 60% bonds. Not good. So what we want to do now is we want to say we still want to be 250, all right? So in this case, what we want to do is we say, okay, well, now we got to erase our bonds there, erase our stocks. So we still want this guy to be 250. Now we need to be, what's that, 150. Because what happens is now, let me go here. Oops. Okay, well, now we got 150 in bonds, 100 in annuity. You know, yeah, you can see that. All right, so that's 250. Bonds plus annuity. And then 250 in stocks. All right, that's what we want to maintain the 50-50 portfolio. And so what this does, though, is they'll say, now you have, what's that, what is that relationship there? 59% stocks, is that what that is? Let's see here. So 400,000 bucks, 250 is in, that's 62% stocks. So we got 62% stocks, and we got, what's that, 37% bonds. So just on this amount right here is 62, 35, 37. People are like, whoa, you're way too aggressive. So you go to a financial advisor and he says, oh, you're way too aggressive. You got 2/3 of your portfolio roughly in stocks and you said you're a 50-50 investor. And he doesn't look at your income statement. That's a huge mistake. Huge mistake, because that is not reflective of your true balance. This is not reflective of your true balance because we're missing out on this annuity. And that's the issue when it comes to how annuities work. You need to put it in your, you've got to put it in your overall balance sheet. Not just your income statement, but your balance sheet, because it has a value for sure. Not only that's a value you can't outlive. Thus, it has an asset. It is an asset. It pays an income that you can't outlive. That's an asset. No other way around that. Yes, it is a cash flow asset, but it is an asset. There is an income you can't outlive. To discount that while we're just looking at a portfolio mix, it would be silly to do. So in this case, I'd say, okay, Mrs. Smith, you come to me, you're like, okay, I need a 50-50 portfolio. I said, what kind of annuities you got? Oh, I got $100,000 in this income annuity. Okay. And we're going to be 150, 250 stocks and bonds. And she's like, whoa, crazy talk. That's way too aggressive. And I say, And she goes, why? I said, because this annuity is considered a bond. It should be looked at your bond for your balance sheet. Oh, I kind of get that. So that means we can afford now to be more aggressive on the remaining of our portfolio because we have that part covered. Does that make sense? That's a big deal. So remember, on top of that too, here we're getting $4,500 a year, I should say, whereas before we were only getting 4%. So now what we do is we have, before we were only getting $20,000. So now we have 4% of this, which is $16,000. Oops, 16,000 bucks. So what we've done here, is we have 16,000 on this, and we're just using the silly 4% rule. And we got 4,500 over here. So now we're getting 20,500 in total income. All right, so we've increased our income by 500 divided by 20,000 by 2.5%. We've increased our income by 2.5% without taking any more risk. In fact, I'd argue we've taken less risk. That is not more risky. That's actually less risky. Why? Because that is guaranteed. It can't go down. Are your bonds guaranteed? Well, if they're government bonds, yes, but if they're corporate bonds, they're not. And if they're government bonds, they're not going to pay as much as a corporate bond. In fact, I'd argue if you're using the 4% rule and you've got government bonds in there and the government bonds are paying 3% as a 10-year treasury right now, 4% rule is contingent on the government bonds paying what? About 5.5 to 6, because when Bill Bengen did that in 1994, that's what the government bonds were paying. They're not paying that. They're paying half that now. So here we're saying, okay, we're going to use the 4% rule, just showing you what I'm just showing you. If you can still use the 4% rule, I don't care. But what I've done now is I've allocated a portion of my bonds, my riskier asset, because bonds are not guaranteed and bonds don't pay as much as they used to, which is what the premise of the 4% rule was. And I put in an income annuity, which is guaranteed to always pay me $4,500 a year, without question. As long as I'm alive, I'll get $4,500 a year. I'm not adjusting this for inflation. I don't know what the inflation adjustments are. No idea. So you'd have to look at it. Do I start with a lower paying annuity as an inflation adjustment, and I don't know what the percentage payment? It might be 4.5%. I don't know. Or do I start with just a flat one which doesn't have an inflation adjustment? Again, you'd have to look at that. I don't know what the rates are for an inflation adjusted annuity. So this right here, I'm just saying $4,500 at 4.5% is your distribution rate, essentially. And so what's going on here is we're saying, okay, now I got $4,500 a year, that's 4.5%, which I simply cannot get here with any stretch of assurance as I can with an annuity, because annuity is guaranteed. The insurance company is guaranteeing it because they're buying individual bonds themselves. So they're taking the risk off you and they're accepting the risk. And the state regulates it. There are insurance company risks too that the state takes, and they say we got to make sure that you're well funded. When it comes to a government or corporate bond, all you're going to get is a yield. That's it. And here you're getting, not only are you getting the 4.5%, but you're also getting some assurance now of guarantee, where you're not getting that in a corporate or government bond when it comes to the money that you get on a regular basis. Because remember, corporate bonds could go bankrupt, which means you lose all your money. That's all there is to it. Insurance company, it could theoretically go bankrupt. Absolutely. I don't want to deny that. It's not FDIC insured or anything like that, but it can say explicitly, we insure this product will be guaranteed for the rest of your life. Now, something could go wrong and you don't get paid. I mean, anything could happen, but certainly that's less likely than a corporate bond going bankrupt. And on top of that, the corporate bond is not paying. If it is paying 4.5%, that means it's much, much more riskier than an insurance company with guarantee. If it's a government bond, it's not paying 4.5%, it's paying 3%, as we just talked about. So that's how you optimize your portfolio when it comes to using an annuity, and then remaining part of your portfolio, make sure it's more aggressive than what it was. Because if you're trying to maintain a 50-50 portfolio stocked upon allocation, and you take a portion of your portfolio to annuitize it, which you definitely should look at doing, the remaining part of your portfolio, if you leave it at 50-50, now you're way too conservative. And that might be appropriate for you. I don't know. But don't just be ignorant. So I'm a 50-50 investor. That means my remaining 400,000 should be 200-200, because that's not the way to look at this. You got to look at a little bit more detail. All right. As always, you like what you see, subscribe. Comments, thoughts, questions, always welcome. So I'll see you guys next time at the Heritage Wealth Planning YouTube channel. And then don't forget to go to the blog, heritagewealthplanning.com. See ya.